Hi, imagine every euro in your bank account is a photograph. Not a metaphor, a real photograph of a moment in your life. The hour you worked, the morning you skipped breakfast to catch a train, the evening you stayed late to finish a project. Every euro you've ever earned is one of those frozen moments. Your time, your energy, your effort, captured and stored in a number on a screen. Now imagine someone is in the room while you sleep, and every night, very quietly, they bleach the photograph. Not all at once, just a little, just enough that you don't notice. After a year, barely visible. After 10 years, the colors look wrong. After 30 years, you can barely make out the image. That's not a metaphor. That's exactly what is happening to your savings. Right now, mathematically, by design. And almost no one understands the rules of the game well enough to stop it. In the next 12 minutes, I'm going to show you what money actually is, why holding it is a guaranteed loss, and how the small number of investors who understand this quietly win, while everyone else keeps watching the photographs fade. Now, quick note before we start. Everything I share here is based on my own research and experience, purely for educational purposes. Everyone's situation is different, so make sure you do your own research and consult a professional financial advisor when you need one. 3 things in this video. 1. What money actually is. The part nobody teaches you in school and nobody explains at the bank. The 5,000-year story behind the numbers in your account. 2. Why holding cash is mathematically guaranteed to lose. Not opinion, not theory, pure math, pure data, hard receipts. And 3. How investors who understand the game actually play it. 3 principles, no fluff, no tricks, just what works. And here's the punch I'll come back to at the end. The most important financial decision you'll ever make isn't which asset to buy, it's whether to stay in cash at all. Let's go. Let me destroy a myth you were probably taught in school. You've heard the story, once upon a time, people traded chickens for axes, but chickens were inconvenient. They walked away, they died, they didn't divide neatly. So humans invented money to make trade easier. Coins replaced chickens, then paper replaced coins, then digits replaced paper. End of story. Now, it's a clean story, but it's also wrong. Anthropologists who actually went out and studied early human societies across continents and across centuries found something completely different. The earliest economies didn't run on barter at all. They ran on credit and debt within communities. You helped your neighbor build a house, they owed you. Months later, they'd help you with the harvest. The debt cleared. No coins, no haggling. Just memory and trust inside a small group of people who knew each other. Money didn't emerge to replace chickens. It emerged when communities got too large and too anonymous for memory and trust to be enough. Money is a technology to track obligations between strangers. That's the real origin story. Then around 600 BCE, in a place called Lydia, modern-day Turkey, coinage was invented. And here's where it gets interesting. Coinage spread across the world for one reason above all others. It solved 2 problems for governments: tax collection and paying soldiers. Try paying 10,000 soldiers in chickens. Try collecting taxes in livestock. Coinage made empire possible. So from the beginning, coinage and political power were bound together. That's not a critique, that's just history. Now, fast forward to the most important date most people never learned in school. August 15, 1971. That's the day President Nixon ended the convertibility of the US dollar to gold. Until that day, dollars were technically backed by gold sitting in vaults. After that day, they weren't backed by anything except trust and law. Within a few years, every other major currency followed. The pound, the yen, the Swiss franc, all of them. For the first time in history, the entire world was running on pure fiat money. Money backed by nothing except state decree and collective belief. How long has this lasted? About 55 years. That's it. Compared to the 5,000-year history of money, you and I are living in an experiment that has been running for the blink of an eye. So when you are saving euros, you are not saving money in some timeless, neutral sense. You are saving in the youngest, most experimental form of money humans have ever used. Which means every photograph in your drawer was taken with a camera that was invented yesterday, and nobody has tested how those photographs hold up over a lifetime. Now the math. 3 subpoints, each one with a hard number you can verify yourself. First, inflation is the policy, not the accident. Open the European Central Bank's website right now. Their inflation target is 2% per year. Open the Federal Reserve's website. Their inflation target is also 2% per year. This isn't hidden, this isn't conspiracy, this is published policy. What does 2% per year mean for your savings? At 2% inflation, money loses about half its purchasing power every 35 years. So a euro today buys roughly half what it bought when somebody born in 1990 was born. That's the target. The actual numbers have often been worse. Eurozone inflation peaked at 10.6% in October 2022. From 2020 to 2024, cumulative Eurozone inflation was roughly 20%. That's a fifth of your purchasing power gone in 4 years. Cash in a savings account paying 1% while inflation runs at 3% is not a safe asset. It's a guaranteed real loss, every day, without exception. Second, the Cantillon Effect, the mechanism behind the inequality you see. Around 1730, an Irish-French banker named Richard Cantillon described something that economists still call by his name today, the Cantillon Effect. Here's the idea. When new money is created by a central bank, by lending or by quantitative easing, that new money doesn't reach everyone at the same time. It enters the economy through a specific door. Large banks, governments, big institutional investors. Those first receivers use the new money to buy assets, stocks, bonds, real estate, before prices have adjusted to reflect the new money supply. By the time wage earners and savers see the new money, through wage increases if they get any, asset prices have already moved. The early receivers gain. The late receivers, savers, wage workers, retirees on fixed incomes, pay the bill. This isn't a theory. It's documented. Mainstream economics. It's also why two people in the same country can experience completely different economies during periods of money creation. Third, the 2008 to 2024 receipts. Let me show you what this looks like in real numbers. The Federal Reserve's balance sheet The money it created went from about $900 billion in 2008 to nearly $9 trillion at peak in 2022. The European Central Bank went from about 1.5 trillion euros to about 8.8 trillion in the same period. Over that exact same window, the S&P 500 rose roughly 4 to 5 times. Real wages in the US and the Eurozone grew in the single digits. And here's the receipt that ends the argument. According to the Federal Reserve's own survey of consumer finances, the top 10% of US households own about 89% of all stocks. So when central banks create money, asset prices rise, and the top 10%, the owners, capture almost all of it. The bottom 90%, the savers, the wage earners, the people holding cash, get the inflation but not the asset gains. This is not opinion, this is the data published by the central banks and the statistics offices themselves. The takeaway is uncomfortable but simple. Holding cash beyond what you need for emergencies is not safe. It's a slow, mathematically guaranteed loss. The faster you accept that, the faster you can do something about it. 2 photographs of the same moment, one left in the drawer for 30 years, one stored properly. Same starting image, same starting effort, completely different ending. Now, the pragmatic core. This is what separates this video from every other money is broken video on YouTube. I'm not stopping at that critique. Here's the playbook. 3 principles. That's it. First, stop being a lender. Start being an owner. When you put money in a savings account, you are a lender. You've lent your money to a bank. They pay you a small interest rate, and they pay you back in currency that's losing value. When you buy a government bond, same thing. You're a lender. You've lent money to a government. They pay you back in currency that's losing value. When you buy stocks, real estate, or an ETF that holds productive companies, you become an owner. You own a share of a business that produces real goods, real services, real cash flows. Those businesses can raise prices when inflation hits. They can adapt. Their value is anchored to real economic activity, not to the value of the currency. The single most important mental shift in personal finance is this one: from lender to owner, from holding money to holding things that money buys. Second, time is the only real edge ordinary investors have. Hedge funds, asset managers, professional traders, they all have one thing in common: quarterly performance pressure. If they have a bad 3 months, their clients pull money. They have to act short term even when they know better. You don't have that pressure. You can buy a broad index fund and hold it for 30 years without telling anyone. You can ride out a 40% drawdown without losing your job. You can sit through a recession that destroys careers in finance. This sounds simple, but it's the only structural advantage you have, and it's enormous. The data backs this up. According to S&P Global SPIVA scorecards, the most comprehensive long-running measurement of this, published twice a year since 2002, over 15 years, more than 90% of US large-cap active equity funds underperform the S&P 500. And the pattern is not limited to the US. In Europe, the year-end 2025 scorecard found that across categories, an average of over 85% of active funds underperformed their benchmarks. This isn't a one-off. SPIVA has published this data for more than 2 decades. The pattern doesn't change. Read that again. The vast majority of paid professionals lose to a simple low-cost index fund over 15 years. over and over. Your patience is your alpha. Nobody can take it from you. Most professionals can't even use it. Third, cost minimization is the only guaranteed return. This one is mathematical, not philosophical. Every euro you pay in fees is a euro you don't compound. A 1% annual fee differential, say paying 1.5% to an active fund versus 0.2% to a broad index ETF, compounds over 40 years to roughly 25 to 30% less final wealth. That's not a typo. A small percentage today destroys a quarter of your retirement. Nobody can guarantee returns. Markets do what they do, but fees are 100% certain. Lower them and you've captured a guaranteed return that requires no skill, no prediction, and no risk. So here's the playbook. Stop being a lender. Use your time horizon. Minimize costs. That's it. That's how investors who understand the game actually play it. This is what it looks like to take the photographs out of the drawer and put them somewhere they can hold their color. Four concrete steps you can take this week. Step 1. Calculate your real cash position. Total everything in checking and savings. Then subtract a 3 to 6 month emergency fund. Anything above that is melting in real terms. Look at the number. Feel uncomfortable. That discomfort is information. Step 2. Decide your conversion timeline. Moving from cash to ownership shouldn't be reckless. Don't dump it all in one day, but it shouldn't be glacial either. Something like spreading the conversion over 6 to 12 months removes the timing pressure. Step 3. Pick your lowest cost broad market index exposure. If you watched my video on investing in Europe, you already know the candidates. Broad ETFs, low TER, boring but reliable. Step 4. Automate it. Behavioral mistakes, the ones I covered in my last video on investor psychology, are what destroy returns. Automation removes you from the equation. You can't panic sell what you didn't manually buy. That's the whole plan. No tricks, no timing, no predictions. Just doing the obvious things that almost nobody does. So back to the photograph. Every euro you earn is a frozen moment of your life. Your time, your energy, your effort, captured and stored. The fade-in isn't going to stop. That's the math. That's the policy. That's the world we live in. The only question is whether you keep leaving the photographs in the drawer or whether you move them somewhere they can grow. You can't say you didn't know the rules anymore. What you do next is yours.